it's like a complex
Do you recognize
issue,
it?
like all this stuff. Yeah.
Did you want some water?
It sounds like it's just loud.
Anybody need any water?
Yeah, it is.
Water,
Did you
water.
leave a meeting? Or,
No, thanks, I didn't check.
no, but
Anybody
for,
need any extra blue books?
for the reading for the
Green
upcoming
books
for
or anything?
Tuesday?
Not yet.
Blue
Dude,
books,
I
blue
just
books?
Should we have your
I don't understand it.
Oh, is it,
That's
is it another philosopher again?
It's like,
Those are so good. They're like everyone.
it's like two guys,
Like
they're talking about,
the whole like
justice,
That's
but it's like, in the most abstract, esoteric way, like,
she never gonna pass
it's-
it
Oh,
to
it's like a conversation.
it's like,
I wish it was.
it's one of those,
The
it's one
crowd
of
was
those,
dead.
it's like,
It was
you know how like
completely dead.
philosophers when they
I was hoping it'd be bigger.
and it's just like needlessly
My phone's
complex
like
for
you
no, like just because it's not clear like what they're
I'm
talking
actually
about.
surprised that
But they never just get to the point of what they're just trying to.
Yeah.
I thought it would be too. I thought it would be good, but it kind of turned into a whole bunch of like that.
I think philosophy is fascinating. I think it's really interesting.
Yeah,
But I
I
think
think we just,
philosophy
I mean, nobody was like
No one
around.
was
Yeah, it's
No,
just
you
kind of
have-
everybody was standing there, and then it's kind of awkward at that point if you try to get
It's
that.
kind of annoying.
Yeah, because
You
you
know,
were like,
yeah.
one minute night.
It's not
It's
bad.
like awkward.
Our classes is
But,
kind of weird.
I'm just, like, for the
Most of your timing's perfect.
talk about this for 3 days, I'm not gonna get in on this discussion.
Really?
I just actively chose
Wow.
not to participate.
And then.
Okay, you ready?
Right.
Okay. So do you want me to just go through the whole thing?
Sure.
Yes.
What I find, and I've been teaching this exam for about, I would say, 3 years now. And I find that pretty tough exam. There's a lot of content. But I find that the majority of my students, particularly here at St. Mary's, I would say I have about a 75% success rate. And then about 25% of the other students just have challenges. You know, they're just probably procrastination, and they're not comfortable writing. You know, they're having a hard time studying. They don't come to the review sessions. They don't review the videos. They don't ask questions. So it's more of just the psychological nature of the student from what I find. But I find the success rate extremely high. And I designed this midterm probably 5 or 7 years ago. And it's basically what I thought was some of the most important concepts that I've learned through my master's and doctorate programs. And, you know, at a level where we have these types of discussions, you know, with my clients and with other senior level executives, this is how they think about stuff. So the first part of it is really hard because you got to think, and then you got to be able to write, and then you got to be able to do the diagrams and show a lot of the detail. The mathematics is pretty easy. Most people just ace the math because they're more comfortable with that portion of it. So it's usually the first part. And also it's the modern portfolio theory. It seems to be the toughest one, along with the technical securities analysis. The students, some are really detail oriented, so they really get into it, and they just nail it. And then other students are in a hurry, and they just, you know, they'll just throw stuff in there thinking that I'm just gonna give them a grade or something like that, where I will just send them back to do it over and over again. And some people will remediate it and put back in the detail, then some people just say, screw it, just give me a C or something like that. And I'll say, no, you gotta go back and do it again. and it drives them crazy. Because that's what we do in business. If you don't get it right the first time, you do it over and over again. You work with the managing director until it's perfect, and then once they sign off on it, boom, you're off to the races and we publish it. Okay, so that's just the way it is. So let's go through the exam. I think the present value stuff is pretty straightforward, so it's really the front stuff. And what I was really trying to do on the first question was to really build on the statistical tools and techniques that you've learned in your quant class, if you've already taken it. So has everybody taken the quant class yet? No? Okay, so you'll be exposed to this stuff. And really at the end of the day is, can you build a forecast model? Can you build a model? Do you feel comfortable building models? whatever the question is. And you're gonna be solving problems, you're gonna be building models, you're gonna build the models based on theory, based on application, and then you're gonna, usually what I do is I like to write my models out, by hand, to see what they would look like theoretically, and then I go get the data and start assembling the data sets. And then once you get the data sets together, then you gotta clean up the data, okay, to get the data uniform so you can apply the regression, okay, or chi-square or some other type of statistical application that's gonna give you the information that then you're gonna be able to make the decisions based off the scientific evidence of the statistics. And if the company is research oriented, which most companies are, they're gonna take the results from the data and the application, and they will implement policy based on it. And if you're right in your policy recommendations based off of your forecasts, then you'll become extremely successful, because that's what we need, is we need to be able to predict, what's gonna happen in the future, and not be reactive, but proactive to things. So the first one is when building a forecast, and you guys, let's make this interactive too, so it's not just boring. Not just me, because again, I really do believe that the future of teaching is more interaction between the students and the professor on a level playing field. It's not this master-slave relationship anymore, that's dead. It's really collaboration and feedback, and really discussion.
Is the camera on? I'm not sure if it is.
It's on. Okay, so when building a forecast model, what are the first steps or questions that need to be taken? So what's the first thing you would do?
What do you think you guys said?
Yeah, like if they're asking for production, sales, returns, whatever it is they're trying to forecast. The first thing I would do is when they come up to you and ask you, will you build us a forecast model to predict production and sales over the next 3 to 6 months? First thing I would say is, what do you think drives sales? And then that will give you an indication of what the independent variables should be within the model. And usually what they will do is they will tell you what they need to forecast, and then you ask them, what do you think drives it? So you're pulling on their knowledge. And if you're a consultant and they bring you in and they say, we really need some help, we really don't know what to forecast, will you give us some recommendations on what the metrics are that we need to be focusing on and we need to be forecasting going forward based on where we are as a company within our growth phase. So they may look to you to come up with the dependent variables. But I would ask them right off the bat, what do you think drives it? And then I would go out and find other people in the firm and ask them questions and do a survey, a qualitative survey. And then I would probably pick up the phone and talk to some of my friends and colleagues in the industry and ask them, I know that you've built these types of models before, what variables do you think should be in the model? And then I'll go to the library and I'll look at the literature, both from industry and academic journals, and look at what has been done scientifically by industry professionals and academics in trying to answer that question. So if you're a semiconductor manufacturer that needs to be able to forecast semiconductor sales and production over the next 3 to 6 months, I'd probably do all of those things, then go into the peer-reviewed journal articles and see what the literature and the theory says. Okay, what's the second question that I would ask, which is probably the second most important?
What are the independent variables?
We just asked that.
Oh,
Okay, so what would be the second question?
Do we have the data?
Let's put them in priority.
Okay.
Okay,
What their budget is?
that would be probably the third one.
When do you need it?
Exactly. It's like, when do you need it? Because that's really gonna determine the budget. Okay, and those are called dependencies. Okay, so you need to know one thing before you can do the other. Okay, and then the third question would be, how much? If you need it by this date, then how much budget do you have, and then who said the data? Yeah, do we already have the data, or do we have to buy the data? Because that could be really expensive. I mean, my current project that I'm working on, we budgeted $125,000 for the data. The data acquisition cost went up to $280, and the partner on the deal was really upset. Now they're kind of renegotiating portions of the contract to take into consideration the increased data acquisition cost. Okay, what else?
Your budget?
Yeah, we just said that. Yeah, what's the budget? Yeah, exactly. How much do we have? Do we have the data? And then do we have the budget? What's the budget? Exactly. Okay, anything else? This is another really important one too. What would be another question?
When do you need it?
Well, we got that one, that was the number 2. Am I working on this by myself, or do I get resources? Right? Am I doing it myself? Am I using myself and my team? And do I have other human resources within the firm that I can draw upon? Because usually you're gonna have to work with IT and the data scientists, or at least the project or the program manager or some IT person to get the data. Okay, so it might be someplace else. So those would be the first ones that I can look at. But really what drives it, and then when, and then everything else comes through that. How do you determine the dependent and independent variable? Well, the dependent variable is going to be told to you by the sponsor, okay, or the client. Or you might have to advise them, okay, on what metrics they should be measuring based on your expertise. And then how do you determine the independent variables? Well, we would ask questions, we would ask professionals, internal, external, and then we would look at the external industry and academic journals to give us some guides on how the model should be structured and what independent variables should be in them. How many variables should be in your model? Once you get past 5, and even 5 is probably stretching it, but once you get past 5, the variables become correlated with each other, so you run into multicollinearity issues. So I'd say 3, 2 at the extreme minimum, 3 is probably a pretty good model, 4 is probably a better model, then 5 is probably as far as you're going to get, but you may already have multicollinearity issues, with 5 independent variables. You'll just have to test it and look at it.
So you would say 4 is the best, probably?
Probably,
Okay,
3,
depending.
2's a little thin, 3's a little better, 4, you're probably about right, 5 maybe stretching it, but no more than 5.
Okay.
Okay. And again, a lot of this stuff is really just based on my experience from the 25 years working in model building. And then how would you test for variable and model significance? Well, the variable, first thing I would do is I would run a correlation test between the independent variable and the dependent variable, or the independent variables to the dependent variables. I'd run the correlation first to see if they were positively or negatively correlated with each other and by how much. Okay. Then the second is I would run the regression and look at the t statistic. And then the next I would look at, and once I run the regression model, I would look at the R-square and the adjusted R-square would be what I would look at next. And then I would look at the F statistic. And then your T statistic usually ranges between positive and -2. So that's kind of around where you want to be, positive or -2. And if the T statistic is negative, then you have a negative correlation. If it's positive, you have positive correlation. Okay. And then the F statistic, usually I would say on the low side around 5, 3 to 5 in there. And then you start to get some pretty good model prediction around 8. And then if your F statistic is coming in around 11 or 13, then you probably have multicollinearity in there because your model's just doing too good of a job forecasting. Okay. And if you were experiencing multicollinearity in your model, and if you had 2 variables that were highly correlated to the dependent variable and correlated to themselves, how would you decide which one to keep and which one to throw out? Most people would use the correlation coefficient of the T statistic to make that decision. But really the correct answer is to do the research in the peer review and the industry journal articles and the research reports and find the variable that has been cited the most in the literature that actually builds the theory around the model. So both variables are correlated to the dependent variable. It just may be a random sampling issue that made that variable have a lower T statistic or correlation. So you would pick the one that was cited the most in the literature. And then internal and external validity. Internal validity is when I talk to people internal within the firm. Yes?
I think it's like which one to throw is the one that didn't cite.
So both of them are, both of them are correlated to each other, you know, and they probably have, maybe, you know, maybe one has a statistical significant T and the other one doesn't, or as much as the other. But that one's been cited the most in the literature going back in time using different samples over time. So that one was cited the most. This one was, you know, just had it was cited, but it had a statistically significant T, but this one was cited the most. So I would, if I had to throw one out, I'd throw out the one with the highest T and pick the one that was cited the most. Okay? Because over time they used random samples, you know, of data over different time intervals, and that variable came up every single time. So it's like, we might just have a batch of data where that variable didn't have as high of a T statistical correlation just because of the data sample. So it was random. Okay. Did that answer your question? Okay. Any other questions on model building? And so that's just, you know, kind of high level to get you to start thinking about, you know, how would you build these models?
You know an example from the variable you will take out?
Yeah, I could, like when I'm building real estate models, the number one variable that drives net absorption and rent growth and valuation is employment. Okay, so if I had to choose between employment and maybe population or employment or household growth rates, I would probably use employment over those two, because the employment is really the number one driver. So if I had to choose between the two, I'd pick employment over population or household growth rates. They're correlated to each other, and they would drive demand in rents and pricing for apartments. So I got three variables that are highly correlated to each other. Okay, that could be in the model. I'd throw out households and population and use employment because it's better. It does a better job, and it's cited the most. Does a better job, and it's cited the most. Okay, any other questions on that?
Can you go through, what this internal and external?
Yeah, internal validity, in my view, and you're gonna run into this, is you need to have buy-off, you know, by your board. You have to have buy-off by senior management, you have to have buy-off by the investment committee, you have to have buy-off by your internal team. So the experience, the knowledge of your internal team and expertise will validate and give you internal validity, because they will say, yes, based on my experience, that model looks right, and the variables that you have in there look right also. So they'll give you internal validation. And then external validity is the citations, you know, the peer-reviewed journal articles, the theory, the citations, and the articles that have been written prior. That's external validity. And you will be asked, well, how did you come up with how did you select the variables? Where'd you get them? Where'd you pick them? What was the research that you did to validate the variables? So they're gonna ask you that.
So what would you say?
So you have to defend yourself,
Like
based on internal validation and external validation. I'd be citing the articles in my head. Usually I'll give them to you, them right there. Morrison Simmons article on, you know, predicting semiconductor sales that was published in 1989, and they did a follow-up in 1992. I'd start citing peer review or industry research to basically support my model. And what doesn't have in here is back testing. Okay. What I would do is I would back test the model and see how it did historically in predicting semiconductor sales.
Would that be considered external validity?
Yeah, that would be external validation. That's really the point. I should have had it in here, but that's really important, because they're gonna ask you, did you backtest the model? And if you did backtest the model, you're gonna have a graph that shows the forecast, you know, what your model forecasted in the actuals. And if they're really correlated to each other, it's like, yeah, we nailed it. And then what you'll do is you'll run a forward test, and you'll track it and test it over maybe a 3 or 6 month period to show that it is actually doing a good job of prediction. And then you're in. Then you make the recommendation at the end. Okay. Did I answer all your questions? Okay. And then the next one, which I think is really important, and this was brought up yesterday at the Latinos in Finance at BlackRock, which is a bit, and these guys manage trillions of dollars in assets. They got at the Exchange Traded Fund. The guy who went up and spoke He's like my age, he's got like 25 years experience. He runs their currency trading division and their currency applications at BlackRock. The guy's just amazing. And he nailed it. It's like all this stuff right here. He said, this is the stuff we talk about right here. So it's not what you're learning from the book. Yes, it's important, but you know current events, and what's going on, particularly in and around the financial crisis and the aftermath associated, because we're living with it every single day. Okay? So I call it unorthodox monetary policy, quantitative easing, which is now quantitative tightening, and the potential for negative interest rates, which is extremely important to understand, because all of the models in your book assume positive risk-free rates. Okay? They assume positive nominal interest rates. But if you go to Japan and if you go to Europe, they've been under a negative interest rate environment for like almost 10 years. Okay, so it's, the models in the book really broken down, and you really need to adjust them and show them. One's theory, the other's application. Okay, so I really thought it was important that you understand unorthodox monetary policy, because the Fed never drove interest rates to zero before in its history in monetary policy. And we never went through a financial crisis of this magnitude, where the Fed printed $5.3 trillion, and put all those bonds on the balance sheet. Never happened before. So we're in kind of a different environment. So this is kind of a trick question. What is the size of the Federal Reserve's balance sheet? And how much money by banks are being held on reserve at the Federal Reserve? It's basically the same thing. Okay, one's an asset, one's a liability. Assets and liabilities have to match. Right? So the number really is 5.3 trillion, although the balance sheet has been whittled down to 4.1. Okay, so that's kind of a, if you say 4.3, to 4.1, that's awesome. Okay, so that's your 2018. So 4.1 trillion to 5.3 trillion. Got it. And then prior to 2017, that was when the financial crisis really started to hit. The balance sheet was around 500 to 800 billion. Okay, so right around that time period. And then I would even say, going back even prior to that, it was starting to build its balance sheet. What do I have as the next date?
Prior to 2007.
What is it? Prior to 2017? Okay, so back in there, it was around 250. It actually went back to like let's say 1970. So 1970 to 2017, it was only like 250 billion. So if you look at the graph, it goes like this for like 30 years, and then 2007 hits, and it just goes like that, and now it's going like this. So just unbelievable amount of money that they printed and bought government-backed securities, government sovereign debt, and they also bought mortgage-backed securities. And there's about, I would say, 2 trillion in U.S. government securities, and there's about 2 trillion in the mortgage-backed securities currently. So that's kind of how the composition of it is. And they're unloading them right now. They're starting to sell them, which is putting downward pressure on bond prices and upward pressure on the yield curve.
What is MBS?
Mortgage-backed securities. Okay, because the housing market was what was over, it was in speculation. People were, basically, you didn't even need to show an income or anything, and you could go and get a mortgage on a house for $1 million and not have enough income to even pay for it or enough down payment. So it was really the housing market. So this is why we accumulated all that, was to save the housing market and the economy. So that answers, though, what has been the growth in the money supply since 2007? So 2007, right, was really the financial crisis, 2010 in there. So the money supply growth was growing at about 30 to 40% per year. And I didn't show this in class, but the equation is the velocity of money times the money supply growth rate equals the inflation rate times real GDP. That's called the quantity theory of money. And that was also another one of Irving Fisher's invention, the guy who invented the Fisher equation. All right, so this is what's important here, is inflation is right around 2%, right? And that's the Fed's target, 3% GDP is the Fed's target. Right? But GDP has basically been underperforming. If you look at it throughout the last 10 years, it's been growing at around maybe 1.7%, and they're targeting 3. Okay, so they're not even there, they can't get it. Okay, and the inflation rate is now at 2%, but really, if you look at the average over the last 10 years, it's been at about 1.5, so it's not even near the Fed's target. And if you hold the velocity of money constant, if you hold all 3 constant, because we're trying to target GDP. So to grow GDP holding inflation and velocity constant, you gotta grow the money supply. Okay? So the Fed was trying during the financial crisis to increase the money supply growth rate at 30 to 40% to get GDP up to 3%. Okay? But it didn't happen. Okay? It didn't happen. And it didn't happen here. And the velocity of money collapsed also at the same time. So as they were trying to increase the money supply to juice GDP and inflation, there was counteracting effects. And this is the number of time money circulates in the economy on an annual basis. So velocity of money was collapsing. They were growing the money supply really fast to try to push up inflation and push up GDP, and it wasn't working because the velocity of money had collapsed. Because people weren't spending money, they were putting it into a bank account. They were putting it in their mattress. They weren't spending it, and they weren't investing it. And this is on a global basis, too. And so it went from 30 to 40%, and then 2011 to 2013, it slowed to around 10% to 8%. So actually the money supply was starting to slow. And then in 2014 to 2018, currently, it slowed to around 2% to 5%. So now you're seeing the money supply growth rate start to slow. Okay. So that's a concern. Because if you look at the graph and you look at the monetary base, you can see the stock market and real estate prices are highly correlated to the monetary base, which has grown through the money supply. So if the Fed's starting to sell off the balance sheet, they're sucking in liquidity from the marketplace. If the money supply growth rate is falling and the monetary base is actually declining, then at some point in time, real estate and stock prices will also probably start to fall as interest rates rise significantly because the Fed's pulling liquidity out of the system by selling the bonds to clean up to unload the balance sheet. So we're looking at a rising interest rate environment. The question becomes, at what point do rising interest rates start to pop the bond and stock market bubble and the real estate market bubble, which we know we're in bubble territory right now. We've never been here before with stocks and real estate pricing.
So I'm just trying to visualize, so if I bought a house right now, in 20 years, basically like the value would have gone down for the house? Is that what you're?
Well, usually if you look at assets, like equities and real estate prices, they go like this, and then you get a recession, and they'll go like this, you get a recession, go like this, you get a recession, so it kind of looks like that. So you're on the upward slope, but you gotta deal with these things.
Okay.
And if you're in the Bay Area, in really good submarkets, the corrective components, like if you're in Lafayette or something like that, you'll probably lose 10% of your value in these recessions. But if you're in Stockton or parts of Sacramento and stuff, your prices could go down 20 or 30%. Because there's just more land out there. It's different.
Okay.
Okay, does that answer your question?
Yeah.
Yeah, okay. But some places in the United States, like in Chicago and, out in the boonies and in Chicago, some of them, they look like this. They look like that. I mean, I valued my mother-in-law's house, and it was like this. Their average annual appreciation rate in Marseilles, Illinois was 0.2 per year for 30 years. Where in the Bay Area, it's like 5% on average, 5 to 10. Okay, so it's a totally different market. All right. So what has been the growth rate in the money supply since 2007? So we already went through that. Has the Fed hit gross domestic product? Yeah, it was what, 4.1? 4.1, 4.2 in 2018. So 4.1%, they're targeting 3%, so the answer is yes. So they've hit it and exceeded it actually. Then the unemployment rate, currently, this is GDP as of the second quarter, 2018 annualized year over year. Got it?
I have a question, sorry. How
Yep.
do you know that their target is 3%?
Yes,
But how do you know?
that's what they said.
Oh,
Yeah, and the long-term potential growth rate for the economy is 3% if you go back post-World War II. So the long-run potential for the economy to grow without any inflation is 3%. Okay. So we're running a little hot right now, which is inflationary and it's going to cause interest rates to go up because the Fed's going to cool it down at some point in time. The U.S. economy is overheating right now on a global basis compared to other countries. And then what about the unemployment rate? What was it? The target is 5%. And I think we're at what, 3.9? Is that right? 3.9 as of last month. So yes, they've not only hit it, but they've exceeded it. And we're starting to see some wage inflation around 2.93%, okay, which is above the 2% the Fed is looking at. So we can even put wage in there. So wage inflation, the target is 2%, and currently it's 2.9%, so yes. And then inflation, the GDP deflator is currently at 2%, and the target's 2%, so yes. And the CPI is come in, I think, at 2.9%, and they're targeting 2%, so yes. So the Fed's hit and exceeded all of its targets. Which basically means that if they hit and exceeded most of their targets, then what's the probability of rising interest rates? Higher, lower? Higher. Okay. Obviously, this lecture was different when I taught it 3-4 years ago, right? We were in a different phase of the business cycle as of today, so the model's changed a little bit.
So, I'm sorry, so when the interest rates are higher, you pay more? You
Yeah,
have to pay more?
yeah, because if you got a perpetuity bond, right, it's the value of the bond, we're just using perpetuity. If interest rates go up, what's the value of your bond do? Does it? If interest rates go up, the bond value goes up? Is that right? Goes down. Got it. And then if we're using dividends, and we're doing the value of stock, we hold the growth rate constant. If interest rates go up, what happens to the value of stocks?
Will go up.
How does that work? If we hold the growth rate constant and the interest rate goes up, or the expected return goes up, what happens to the value of the stock? If the interest rate goes up holding the growth rate constant using the Gordon growth model, what happens to the value of the stock?
Decrease.
It goes down. Got it. And if you use net operating income, hold that constant divided by the cap rate. If the cap rate goes up because interest rates are going up, what's gonna happen to the value of real estate? This goes up, this goes
Down.
down. It's just mathematics. Okay. So if the Fed's hit and exceeded all of their targets, then what's the probability of rising interest rates? High. And if the probability of rising interest rates, what is the probability of falling asset prices? Okay, you guys are now economists. And you're forecasters now. So that's the logic, okay? That's the logic. All CFOs, CEOs, COOs, traders, portfolio managers, economists, you name it, this is the logic. This is what they think through. Because if I know that the value of my real estate and my stock and bond portfolio is gonna go down, what am I gonna do? What do I do? What do I do? Yeah, if I did the forecasts, and I think that interest rates are gonna rise fast and higher over the next 12 to 24 months, and the value of my stock, bond, and real estate portfolio is gonna go down, what am I gonna do?
Sell.
I might be able to sell some of it, you know, if I can. I'm not gonna liquidate everything. But I might wanna start applying some of the derivative contracts, you know, to hedge off some of this market risk, okay, for as long as I can, to try to preserve the value of the portfolio, okay? All right, if we were to fall into a recession, would the Fed use negative interest rate policy? Yes, okay, they already said it, okay? And interest rates are still historically low. So at some point in time, you can only lower interest rates so far, right? So what's the lower bound on interest rates? What's the lower bound if I got the yield curve? How far can I lower interest rates? Theoretically, in the United States. Yield curve. Yield curve usually goes like that. How far can I lower the interest rates? In most cases. Can I lower them to zero? Yes, that's what they did. They lowered them to zero. The yield curve is basically like this for years. Zero. You got zero. Okay. But in Europe it was like this. And in Japan it was like this. That was their yield curve. Theirs is negative. Okay. So the question is, you know, would the Fed, in a recession, would the Fed use negative interest rate policy? The answer is yes, okay? So they will use unorthodox monetary policy. And if they do use negative interest rates, there could be major consequences for the marketplace, for the capital markets. What would be the impact on the economy? Well, if interest rates went negative, it would probably stimulate investment and consumption because the cost of capital is now cheaper, okay? Unless you fall into a Keynesian liquidity trap, and you could lower interest rates to even negative or zero, and it still won't spur business investment or consumption because people are scared. Okay, businesses are scared. They're not going to invest at any cost of capital, okay, even if it's negative or zero. So it'll be stimulative for the economy. What about asset prices? We already talked about that. So if they drive interest rates down negative because they're trying to prop up asset prices, if they drive interest rates negative, it's going to drive down expected returns, it's going to drive down interest rates, it's going to drive down the cost of capital, and what's it going to do to bond prices when interest rates fall? Yeah, they're going to go up. And what's going to happen to stocks when interest rates go down and expected returns go down? They're going to go up. And what's going to happen to the value of real estate if interest rates go down, borrowing costs go down, and cap rates go down? They're going to go up. So the Federal Reserve will implement negative interest rate policy to prop up asset prices. And if the asset prices are propped up and you actually own some of these asset classes, how do you feel? Do you feel better? Do you feel good when the values are going down? No. Do you feel good when the values are going up? Yeah, because you feel richer. Okay. And if you can prop up these values, particularly the bonds and the real estate, those are the collateral, and those sit on the asset side of the bank's balance sheets. So if the values are going up, then the leverage ratios are coming down. Okay. So it's actually stabilizing the bank's balance sheet so they don't go insolvent. And if they did go insolvent, there'll be a run on the banks. So that's what the Fed did. By running interest rates to zero, It propped up these asset prices and made everybody feel better, and actually propped up the banking system and saved the system from runs on the bank and a financial collapse. Okay? And they did it through unorthodox monetary policy. So the asset prices will be propped up. What about the savers? Well, under a negative interest rate policy, if you're buying these negative interest rate bonds, you're worse off, right? Because you're basically paying a tax to buy the sovereign bonds, to basically hold them as for liquidity purposes, but you're not getting any interest rate. And not only are you getting negative nominal interest rates, but if you throw in the inflation rate, if there is any, your real rate of return is actually even negative, more negative. So you're even worse off in the end. So savers, it's a total disaster. And the Japanese savers are literally going crazy right now because they've been under negative interest rate environment for like 12 years. So a lot of the retirees are just, in a horrible position. The investors will benefit because they're getting their assets are being propped up by overly accommodative monetary policy. So the investors, if you do own actually any of these asset classes, and most people in the United States don't own stock. Okay? The majority of the wealth in the United States is held by the top 99 percentile. Almost 90% is held by the top 90th percentile, which is extremely unfortunate. And then businesses will benefit too because they can borrow at extremely low costs of capital. And what they've done over the last 10 years is they've borrowed in the bond market at really low interest rates and bought back their stock and propped up the stock price through financial engineering, not top line revenue growth. Okay? All right. Got it? So using the Fisher equation, what variables drive the risk-free rate or nominal interest rates? Does the real rate move a lot? Does the real rate move a lot in the Fisher equation?
No.
No. So it's basically a constant. So what variable drives nominal interest rates up and down and the yield curve up and down? Inflation expectations, exactly. The simple Fisher equation is just the real rate plus inflation expectations. And these are my notations. Every book has a different notation. I just made these up myself. Okay. So what variables drive risk-free rates? And these nominal interest rates are also risk-free too, when you're talking about U.S. government securities. So what variables drive risk-free rates up and down? The real rate and inflation expectations will drive the yield curve up and down. And this is obviously a normal curve. This is the maturity on the bond. This is the yield to maturity or the nominal interest rate. Right? And then you're going to have an interest rate associated with each maturity of the government bond. And again, remember this yield curve is also the risk-free rate. And the dominant securities in the marketplace is the 3-month, the 6-month, the 9-month, the 1 year. That's going to be the money market. And any bond or any security that has a life more than 1 year is the capital market. Then you're going to have 1 year, 3 year, 5 year, 7 year, 10 year, 20 year, 30 year bonds. And there's not a lot of 20 and 30 year bonds out there. And Alan Greenspan said if you wanted to monitor one interest rate, that basically will be telling of where the economy is going to go. He said to focus on the 10-year because it has an inflation expectation premium embedded in it. Okay. So if inflation expectations go up, and if it's equally distributed across the curve, then the yield curve is going to shift up. inflation expectations fall. And if it's equally distributed across the curve, then the yield curve is going to go down. And we know I'm just going to use the simple perpetuity model. Coupon I equals the value of the bond. So if the inflation expectations move up, then the nominal interest rate is going to move up, and the value of the bond is going to move down. And if inflation expectations go down, the interest rates go down, and the value of the bond goes up. Okay, so that's kind of the mechanics here. Up and down shifts the yield curve up and down and flattens and inverts it. Show the equation and the graphical representation of a normal, flat, and inverted curve. And what are the three, and there's really four theories. So what I like to look for on the exam is 1, 2, 3 curves. You got it. Upward slope, sloping yield curve, or a normal curve. And then what I'd like to do is to put in the Fisher equation plus inflation expectations. And in a normal curve, the inflation expectations is positive. And then you have a flat curve. And under a flat curve, basically your Fisher equation, inflation expectations are 0. And in an inverted curve, under the Fisher equation, your inflation expectations are negative. So that's kind of what I'm looking for. And then the four theories. First one is the expectations hypothesis, which is the Fisher equation. And the second one is market segmentation. Preferred habitat. And liquidity preference. And these are all related to each other, which basically states that the yield curve is segmented. So there's the market segmented. So you have basically businesses and other investors that just buy and sell bonds on the short end of the term structure. And this could be called the term structure or the yield curve. It's the same thing. Term structure is just more of a technical term. So this would be considered the short end of the curve. And then you got the medium term. So some investors and lenders and borrowers and bonds prefer to be in the medium maturity range of the curve. And then you have the long end of the yield curve, or long end of the term structure. So under the market segmentation and preferred, where they prefer to be, preferred habitat, and their liquidity preference. You don't need the liquidity when you're going to buy a medium and long-term bond. If you need liquidity in your money, within 3 to 6 months, you're going to be in the short end of the curve. Okay? So the market segmented. This is right up the alley for marketing students. Because because we always look at market segmentation in marketing, so it's the same application. Okay, then the question is, show the equation graph of a normal upward sloping flat and inverted curve. Got it. What are the yield curve theories? Got it. What impact do movements and shifts in the yield curve have on asset prices? We already showed that here. How does the Federal Reserve influence interest rates? What policy tool do they use to move interest rates? What is the objective of buying and selling bonds? If the Fed buys and sells bond, what is the impact on bond prices? What is the impact on interest rates and yield maturity? Does the Fed control and influence directly short-term or long-term interest rates or both? Okay, so the monetary policy tool that's used to move interest rates up and down, particularly short-term interest rates, is open market operations is the tool. And basically out of the Federal Reserve Bank of New York City, the Federal Reserve will buy and sell bonds in the open market. Well, if they buy bonds, and that's going to cause the bond prices to go up, and it's going to cause interest rates to go down, and it's going to stimulate GDP, cause GDP to go up. If they sell bonds, then bond prices are going to go down. Interest rates are going to go up, and they're going to try to cool the economy to mitigate the inflation, the deterioration in inflation. So this is how I usually did it when I was going through and studying financial economics and economics. I would set up these relationships like this so I could memorize them. Because then when you get out there in the real world, the formula comes to you and you can just walk through the process and then articulate the logic to whoever you're consulting or whoever you're talking to. Okay. All right. So again, what policy tool do they use to move interest rates? Open market operations. What is the objective of buying and selling bonds? To basically drive bond prices up and down, interest rates up and down, to either stimulate or cool the economy. Quote unquote. If the Fed buys and sells bonds, what is the impact on bond prices? We already said that. What is the impact on interest rates? And we know that too. Okay. Does the Federal Reserve control and influence directly short-term interest rates? Yes. The Federal Reserve controls short-term interest rates. And you'll see as the Fed starts to sell off the bonds, the yield curve, particularly on the short end, starts to flatten. And then right now we're dangerously close to an inverted curve. I haven't seen this in over 10 years. We're really close. And then if the Fed inverts the curve, that's a big problem. As we already talked about. The stock market will peak in a year and we'll be in a recession in 24. Okay. Does the Fed control and influence directly short-term interest rates? Yes. Or long-term interest rates. They do actually influence long-term interest rates indirectly, okay? Because if they raise interest rates too fast, too far on the short end and actually invert the curve, then the inflation expectations will turn negative, and actually the curve will, long end of the curve will start to be pushed down because people are anticipating a recession within 3 to 5 years. So the Fed will be jacking it, inverting it, and then the market will start basically dumping bonds here and buying bonds out here because they see lower interest rates in the future, which mean long-term bond prices are going to go up. So they start to shift. They sell off here and buy here. All right. Does the Federal Reserve control and influence directly short-term interest rates? Yes. Long-term interest rates, indirectly. Okay, indirectly. Because the market really controls the long end of the curve. Any questions on that? No. What were your overall observations of the relationship or correlation between the yield curve and the S&P 500? Well, we know that the S&P 500 peaked under a normal curve, normal upward sloping curve. And then as the curve started to flatten, and when it inverted, the stock market peaked in less than a year, and we were in a recession in less than 24. Okay. So what were your overall observations between the yield curve and the S&P 500? They're negatively correlated, right? As interest rates go up, then eventually stock prices go down. Did the yield curve lead or lag the peak of the market? It led the market. If it did, by how many months? 12 months for the stock market, 24 months for the recession. Did the curve flatten or invert? Yes, it did. Prior to the peak, yes, it did. On the short end or long end of the curve? On the short end of the curve. Can you use the yield curve to predict stock market peaks and recessions? Yes. If it inverts, the stock market peaks in less than 12 months, and we're in a recession in less than 24. Okay. Why is it important to track stock, bond, oil, and gold prices and the value of the US dollar? These are the major asset classes. The majority of all institutional and retail wealth is in these asset classes. And trillions and trillions of dollars are traded in these asset classes every single day on a global basis, instantaneously, 24 hours a day, 7 days a week. Okay, so
sorry, what's the first one there?
That these major asset classes are held as assets by institutional investors and retail investors. You guys own this stuff. Okay, this is where you store your wealth, is in these major asset classes. Okay, and most corporations and pension funds and endowments own these asset classes. So we're all bought into these asset classes, one way or another. So it only makes sense that you monitor these asset class movements and try to forecast where they're going to go. Where are these asset classes today? Well, we know that the Dow Jones is what? Above 26,000 something, right? And it's been what? Appreciating around 20% this year so far and over the last 2 years, which is extremely high because the average is 8. We know that the bond yields right now are above 3.1% on the 10-year Treasury. That interest rates have been rising particularly over the last 6 to 9 months. We know that oil prices now are well above $70 a barrel. Do I go in too fast?
I just missed the Dow.
I'm sorry. The Dow Jones is well above 26,000 right now. The Dow Jones Industrial Average. And on an annual basis, it's up around 22%, which is well above the long-term average of 8. Okay, so I'm just testing to see if you're monitoring the markets. And if you can tell me why it's up or down, usually the only 2 reasons why the stock market's up is either low overall interest rates and 2, higher earnings growth expectations due to a rapidly growing economy and very low unemployment and rising investment by businesses. So all that'll come out of your research that you're doing when you're reading the articles around these asset classes. So this is really to test you to see if you're monitoring the markets, if you're memorizing the level and the reasons why they go up and down. And then the bond market, the 10-year Treasury is above, I think it's like 3.1%, which is significantly higher than it was over a year ago. Okay, so rising interest rates, which means falling bond prices. And then oil is now trading above $70 a barrel. Yeah, so if you go back a year or 2, it was trading at about $45 a barrel. So it's significantly higher than it was over the last 2 years. And that's due to OPEC cutting back and just overall global GDP growth rates in China and India, and particularly the US too. And then gold prices really haven't done anything. They've been trading around $1,200 an ounce. They have moved up over the last 3 months, but if you go back 3 to 5 years, it's basically been flatlined. So it hasn't done anything. But gold prices, if you go back to 2009, during the recession, it peaked out like at 1,800 or 2,200. Yeah, it was really high, and then it's come down since then. And then the value of the dollar, what is the dollar to the pound right now? 1 point?
Like
or something like that. And then the dollar to the euro is like 1.18 or something like that, yeah. And then, the dollar's been appreciating and now it may be depreciating, so you gotta kind of know where it is in its trend. And then obviously the euro's been appreciating over the last 2 years because of economic growth rates. And then out of Britain, the pound got pummeled after Brexit, and then it's slowly been recovering since then. And really the Brexit talks will have a major effect on the movement in exchange rates between the dollar and the pound.
Sorry, what was the dollar to the euro again?
Dollar to the euro is what, 1.18, right around there. Okay, and then where are these asset classes trading? I already gave that to you. Are they up or down for the week, month, and year? What drives these prices and values up and down? We already went through that, right, with the supply and demand analysis with those factors. And then give examples or factors that drive them up and down. And that's kind of related to the next one too, right? Which is the dynamic asset class supply demand analysis. Did you have any questions on this, on those? So I was just testing you there to see if you were monitoring the markets. And you should, it only takes like 2 minutes, every morning to go check Yahoo Finance and just see where the markets are trading. And then check it again at 1 o'clock in the afternoon when the markets close. I don't need you to monitor Europe, or London, and I don't need you to monitor Tokyo or Shanghai. Although always remember that at the end of the day, Tokyo is opening, and then in the morning, London's closing. Just to give you kind of a global perspective. And then the supply-demand analysis. Do I need to go through all of this?
Might as well.
I just want to be cognizant of time too. So I would set it up. I would just set up 2. This is a really good exercise for you to really solidify your microeconomic applications to these major asset classes. So obviously, we're always going to start off in equilibrium, and then we're going to shock the system. And I usually do supply first. And then I do demand. This is going to be quantity. It's going to be quantity supplied. Okay, and this is going to be quantity demand. Okay, does that look right? Looks pretty good. And then I like to do color codes. Color coding these things. So we're going to do, and I'm going to go through this pretty quickly. And then you might have more factors than I do. So it's going to be supply, it's going to be stock. Oil. US dollar. Or we could also do foreign exchange. So the first thing I like to do, and I'll use green or blue, you can decide what you want to do, is I want to shock the system back under supply constraints. So this is the shifting back of the supply curve. And we know if the supply curve shifts back, the quantity supplied shifts back, and the prices of stocks are propped up. And what would be an example of a shifting back of the supply curve? Well, one would be stock buybacks. And reverse stock splits. majority over the last 10 years has been buybacks. Where they issued a bunch of bonds at really low interest rates and then went in and bought their stock back to prop up the stock prices, to get their stock options in the money. And then they liquidated their position. So there's a little conflict of interest there. And then what would cause the supply curve to shift out? Causing the quantity supplied to shift out and prices to fall. That would be initial public offerings, secondary offerings, which are also called seasoned offerings. And actually, you can put in stock splits there. But the majority is going to be IPOs and secondary issuance of stock by existing companies that already have securities in the marketplace.
For the test, you want us to memorize the reasoning too?
Yeah, I'd want to see how good you do if you can remember, because this stuff's really important, right, to understand.
I'm sorry, what is, when you say stock buybacks, what does that mean?
You're basically going to, this is what's happened over the last 10 years, is because interest rates were so low, the corporations basically issued a bunch of bonds at very low interest rates and went back into the stock market and bought back their stock and propped up the stock prices. So that's it, they bought back their stock. Okay. All right, because that's going to shift the curve back because you're taking supply out of the marketplace. So you're artificially propping up the stock prices. Okay, that's called financial engineering. Okay, on the demand side, stay consistent. What would cause the demand curve to shift up? Quantity demanded to shift out, and the price of the stock to go up. Well, one would be higher earnings growth expectations. Because remember, under the Fisher equation, as the growth rate goes up, the stock value goes up. And this is going to be driven by higher GDP, profits, earnings, EBITDA cash flows, and other factors, mostly macro factors, that are going to cause it to go up. Higher demand also through lower interest rates would also increase demand for stocks, because then corporations can borrow cheaply and then invest and grow their revenues in the future by buying assets that are more productive. Any others that you can think of? I might have some others, you know, from the list that I gave you in class. I just can't remember them right now. Okay, so let's do oil. What would cause the...
Right. What about the second to the demand rate to the left?
Oh, thank you, I appreciate it. What would cause the demand curve? Thanks, Noah. What would cause the demand curve to shift down? The quantity demanded to shift back, and prices of the stocks to drop. Basically, I just reverse these. Basically, I just go lower, right?
Lower return.
Yeah, lower GDP, lower profits, lower earnings per share, lower EBITDA, and higher interest rates.
Higher interest.
Yeah. Yeah, I like that too, higher risk. Yeah, that's good. You might as well add that up in here too, right? Lower risk. And you can even put lower economic risk. Okay. I don't need to write these out, do I?
No.
Okay. Got it. Okay, now, did I answer your question?
Mm.
Okay, let's do oil. So what would cause the supply curve to shift back for oil? OPEC.
Middle East, like war in the Middle East.
Yeah. OPEC cutbacks. Or at least. I would say those are probably the two biggest factors that would cause the supply curve to shift back. And then what would cause the supply curve to shift out? Basically the same. OPEC, production. And I would even say global. Because we have Venezuela and Russia and other countries that are also producing into the global markets. We also have fracking now. Fracking, so the U.S. is exporting oil for the first time into the global markets because of fracking. That's really technology, right? It's tech driven. So that's going to push the supply curve out, quantity of supply out, and the price of oil down. Yes.
Would the supply of oil go down if a major consumer like
It would shift back, is that what you're asking?
Yeah, sorry. If a major consumer like the United States, say of OPEC, started just producing all their own oil through fracking, would that?
No, that would just increase the supply, it wouldn't shift it back.
Okay.
This is another one here, natural disasters. Right, Hurricane Florence is her name. Harvey, all those guys, disrupt the oil production in Houston and New Orleans, and a lot of they'll get disrupted. Okay, and then on the demand side, what would cause quantity demanded to increase and prices to go up? I would say global GDP. And the biggest consumer is China, in the US, India, Europe. So GDP, production. And then what would cause demand to go down? Recession. Got it. Recession. How about substitution?
Technology?
Yeah. Substitution, tech, electric cars, and then alternative, renewable energy. Right? Because California's going to all renewable in what? Probably not in my lifetime, in your lifetime. By 2020 something, 25 or something like that. Oh, 45, 45. Right? 45.
I was about to say you're not expecting to live very long.
Gee, thanks. I'll take that as a compliment. Okay, let's do gold. So what would cause the supply cut? This was a hard one for me. What would cause the supply curve to shift back?
Hoarding, reserve.
Oh yeah, hoarding. Hoarding, central bank.
Just sit on it.
Yeah, central bank and treasury. Holdings. Yeah, I think Russia's like accumulating and holding a ton of gold right now to prop up its currency. It's going into free fall. Maybe you guys can figure out some other stuff. What would cause the supply curve to shift out for gold? Well, obviously extraction. Mining. Technologies. And I would also say maybe cultural shifts, although it hasn't happened yet. Gold is given and held in dowries in between families in India and China. They're one of the biggest consumers and holder of gold. And then what would cause the demand curve to shift up for gold? Fear. War. Geopolitical uncertainty. High rising inflation. Currency devaluation, depreciation, but also drive people into gold to preserve their wealth. Economic uncertainty to cause the demand curve to show. In the 2009, 2010 people, gold prices hit like almost 2,000. 1,800, 2,000, because people were scared. They thought the sky was falling. And then what would cause a demand for gold to shift back? Peace. Let's see, geopolitical certainty and disinflation. Deflation. You actually have falling asset prices and falling commodity prices. Less incentive to hold gold. Okay, for the bonds, what would cause the bond curve to shift back? The only thing I could think of, or there was two of them. One would be, budget surpluses, where you're actually buying back the debt in the open market, which is what happened in the Clinton administration with Greenspan. We ran a budget deficit for like 4 years, and they went back and they started buying bonds. The other is maturing bonds. So if the bonds come due, they're not being replaced. So the supply curve is shifting. That's one of the biggest concerns right now is that the bonds are maturing on the Fed's balance sheet, and they're not being really replaced. So there theoretically could be a shortage in U.S. Treasury securities because everybody uses them to transact transactions. What would cause the supply curve to shift out? Massive budget deficits. Running budget deficits and there's not enough demand to soak up all of that paper, then the supply curve is going to shift out. Another concern is foreign sell-off of the U.S. Treasury securities. China's not happy with this with these trade talks. He said, well, if you don't give us some concessions, on the tariffs, what we're going to do is we're going to sell off your bonds. And that's basically going to put down pressure on your bond prices, upward pressure on interest rates, and we'll send your economy into a recession. That's kind of another implied what's going on. I think those are the two. What would cause demand for the bonds to go up? Fear. Need liquidity, slower GDP growth, and lower inflation expectations. Just some of the ones I came up with. And then what would cause the demand curve to go down? Less fear and higher returns. Stock market. might be other stuff I came up with. I'm just trying to work through this quickly. And then when you do currencies, you have to change the price to value. So we're looking at the value of the currency, we're not looking at the price of the currency. And that's where a lot of students get confused too. I'd like to change it. Evaluation. So what would cause the supply of dollars to move back? Basically, you're taking dollars out of the marketplace. So you're not buying bonds, you're selling bonds. Selling bonds? No, that's not right. You're buying bonds. So if I buy bonds, buy the bonds, I'm injecting dollars into the marketplace. Right? If I sell bonds, I'm pulling dollars out of the marketplace. Selling bonds. We could say slow or no money supply growth. It's actually going in reverse. And actually, theoretically, a supply curve would shift back for dollars too under inflation. Right? Because inflation deteriorates the dollar, which theoretically is. Right? You're pulling dollars out of the market through inflation. Right? Because there's not as many dollars out there because the inflation is eating it. Okay? That's a tough one. What would cause the supply curve to shift out? Buying bonds. High money supply growth rates. Deflation. Disinflation. What would cause the demand curve to move up for dollars? Higher expected returns, stock, bond, real estate markets, low inflation, higher interest rates, higher labor productivity, foreign currency devaluation, depreciation. Foreign geopolitical risk would drive higher demand for the US dollar. And then it would just be the reverse, right? You just reverse these. Lower expected return stock market, higher inflation, lower interest rates, lower labor productivity, foreign currency appreciation, revaluation, and lower foreign geopolitical risk. You just flip it. That would be your factors. Okay. All right. What's the next one? How are we doing? Oh, we're doing pretty good. Okay. What I want to do is let me skip over the financial product innovation and engineering one. Okay. I want to go straight to the one. Okay. Did you want to take a picture of this, or is this good? Can I erase it?
Wait, hold on, what's the other one for the?
It's just the opposite of this.
That's fair.
Yeah, so you just turn it around. And you have these notes too.
Yeah.
Yeah, I gave them to you. And there may be other factors in there too that I missed. Okay. So let's do the modern and postmodern portfolio here, because that one's usually the toughest one, along with the technical analysis. And the other one's pretty straightforward. We may not get to the math stuff, the problems, so you guys have problems with problems. You can probably go over those quickly, but they're pretty straightforward. Okay, this is the tough one. This is where everybody, because it's so detailed. Did you have a question? Did you have a question?
Oh, I'm asking on the.
Yeah, we're doing that. Okay, so this is how I would do it. Okay, and I've been practicing how to do this thing for years. I think I finally got it together. It took me years to like figure it out. It's like screwed it up every single time. Literally, like every time I always like, screwed it up. But I think I finally got it. And I don't know why it's an umbrella. I haven't made that call yet, or I haven't talked to you, but I will get you there. So the first thing I do is I go like that. And I put in the capital allocation line, okay? And then the intercept on the y-axis is your risk-free rate, okay? And in my investments class and my international class, we actually redo this. I make them redo this under a negative interest rate environment. We're not going to do that here. But under a negative interest rate environment, it pushes down the expected return. It's down here. I find that kind of fascinating. So then what I would do is I would go right here, and it's got to be like, okay, and make sure that this little tail is above this risk-free rate. Okay. And then what I do is I go like this. I put it in the umbrella. I'm going to do 100% stock. I'm going to do 100% bond portfolio. And then I start putting in the details. I like to see ER, STK. This is going to be the standard deviation of the portfolio for stock. This is the standard deviation of the bond portfolio. This is the expected return of the bond portfolio. This right here is your market basket. And then I go right here again, and I go like that, and I go like that, and like that, and like that. 'Cause most of my students will write these in, but they won't go tangent, okay? And these are utility curve, or also called indifference curves. 1, 2, 3. And we know that investors want to be up here, high return, low risk, but there's nothing there. So they have to bring down their utility, and they can construct a portfolio at the point where the utility curve, capital allocation line, and the efficient frontier are tangent.
I'm sorry, can you repeat that one more time?
Yeah. So the market basket is the point in which the utility curve, the capital allocation line, and the efficient frontier are tangent to each other. Okay. And then remember that I can construct a portfolio between stocks and bonds anywhere on and along and inside the efficient frontier. I can go out and I can construct a portfolio on behalf of my client any point along the curve and any point within the curve.
What are those points, sir?
Those are portfolios that I can construct. Okay, they're available in the marketplace and I can put them together for my client. Okay. So let's say, so this is standard deviation P. This is expected return P star. Okay. And at this point, also along at that tangency point too, I can, my expected return on the portfolio divided by the standard deviation of the portfolio. At that point right there, my risk adjusted rate of return is maximized. Maximized. I'll get into it a little bit later. Okay.
Can you explain again what's the denominator?
Yeah, this is the expected return on the portfolio. So let's say this is a 50-50, 50% stock, 50% bonds. Okay, and I'll calculate my weighted average expected return on the portfolio. And I'll do the same thing with the portfolio risk or the portfolio standard deviation. But at this point, I'm getting the highest risk-adjusted rate of return. I'm maxing it out. Okay, at that point. That's the point where the investors, where they're the best off. Okay. So now let's start to do some dynamics here. So I can, if I'm an investor and I want a higher rate of return and I'm willing to take on more risk, I'm going to sell off my bonds and I'm going to start buying more stock. So I can move out the efficient frontier. And if I'm a investor that wants low risk and I'm willing to take lower return, I can sell off my stock portion of my portfolio and I can take on more bonds and move down the efficient frontier.
Can you explain what is the arrow to 100%?
Yeah, so I'm selling off bonds and I'm buying more stock. And eventually I'll get to 100% stock portfolio. So I won't have any bonds in it. If I want a higher rate of return, but I'm willing to take on more risk. So I'm a risk neutral investor. I don't care about risk, I care about return.
What would be a scenario where you would do that?
I could build this, what we do in my other class, and we may do this in this class. For example, I can build a portfolio of the top 25 tech stocks and put that into my portfolio. The return's gonna be really high, but so is the volatility in it. So that would be an example of building a high return, high risk stock portfolio. Okay. And then what if I'm an investor, it's like, no, I don't mind getting low return, but because I'm really more concerned about the risk. So you're gonna sell off your stocks and you're gonna increase the allocation to your bonds. And at some point you may just say, screw it, I'm out of stocks completely, and my portfolio is gonna be 100% bonds. Okay, everybody get that? Okay. Now the next thing is I can jump off the efficient frontier. I can jump off the efficient frontier, and I can move up the capital allocation line. And what I can do is I can get to a higher I'm going to get to higher risk, but I'm going to get to significantly higher return. And by jumping off the efficient frontier, what I'm going to do is I'm going to use leverage. I'm going to use margin. I'm going to buy on margin for my stocks. I'm going to use mortgage. I'm going to use bank financing for my real estate to lever up my return on equity. So I can take on more risk, but I'm going to get significantly more return by using somebody else's money, okay, if I'm right. can also jump off the efficient frontier and move down the capital allocation line through the process of lending. And what that's going to do is it's going to significantly lower my expected return on the portfolio. But I'm going to significantly lower the risk. And that's what banks do. Banks will lend you money for your business, lend you money for your real estate, lend you money for your stock portfolio, but all of those are collateral for the loan. And if you don't pay them back, they'll take your business. They'll take your real estate, and they'll take your stocks.
Your legs.
They'll take everything, right? If you're borrowing from the mafia, yeah, they will take your legs. Okay, all right. So the next thing is, which is fascinating, is that there's been certain types of market allocations over the years. So 1920 to basically 1970, I was in the business. I'd be building portfolios with 70% stock, or 70% bonds, and 30% stock. So that was basically our allocation here. And then from 1970 to 1980, we basically, the research from Ibbotson, they ran all of this. They basically said, you need to reduce your allocation to bonds, keep your allocation to stocks, and you need to allocate 10% of your portfolio to direct real estate. That real estate securities, but actually physical real estate. Okay? So that shifted the market basket by institutionalizing and legitimizing real estate. And then from 1980 to 1990, Ibbotson did research again, said based on the analytics, you should have 50% of your wealth in cash flows and bonds, 30% in stock, 10% in real estate, and 10% in cash value life insurance. And that institutionalized the insurance products. And all banks at that point, after that point, started holding cash value life insurance policies in their institutions based off of their senior level managers. And all the cash value that was put into these policies they used as tier 1 liquid capital to meet their liquidity requirements under bank regulation. So it legitimized it, which is amazing. And then from 1990 to 2018, it was Deutsche Bank, Reef, and I actually did the research. And I think when I started doing this was in 2009 when I did this research. And they said take down the allocation to 40% bonds, 30% stock, 10% real estate, 10% cash value life insurance, and then another 10% would go into alternative, renewable energy. So these right here, these are the alternative assets right here. These are called alternative assets. And what's unique about these alternative assets is they have low, no, and negative correlation in their returns with stocks and bonds. So these alternatives have low, no, and negative correlation in their returns with stocks and bonds. So that if you add those asset classes to your portfolio, what it's going to do is it's going to bow out the efficient frontier. It bows out the efficient frontier. And in the process, expected return on the alternatives is going to go down, but your portfolio standard deviation goes down even more. So if you can, through diversification, through these alternatives, reduce the expected return on the portfolio, but significantly reduce the portfolio standard deviation even more, you're going to increase the risk-adjusted rate of return, which is what the institutional investors want. And if you can target and get them expected returns of 8% to 10%, then the portfolio is going to double in less than 10 years. So if I can get them lock that in, and lower this through diversification and increase the risk-adjusted rate of return, my clients are better off. Okay. So this bowing out of the efficient frontier is critical. That's the first thing I look for, on the exam. And then the last piece is that through the insurance product, particularly for high net worth individuals and others who have large responsibilities in their business and nonprofits and their estates and those things, they will have large amounts of life insurance to mitigate any damage that's lost due to their expiration, due to them dying. And if they do pass away, the death benefit is injected into the estate, and the beneficiaries of the estate will actually move up onto a higher utility curve, and their expected returns will be even higher because of the insurance, the wealth effect. Which is where the risk-averse investors wanted to be originally. They wanted to be on a higher utility curve, but they couldn't get there. But they can get there through the wealth effect, through the life insurance if it's applied. And then I can also bow out the efficient frontier through the use, I'll do this, and I can also and this is modern portfolio theory. This is MPT. This is the application of modern portfolio theory. Postmodern portfolio theory would state, I can also bow out the efficient frontier through the use of derivative contracts. And I can use derivative contracts as the tools to apply portfolio insurance. Through the use of financial engineering. And if I think that the value of my exchange traded funds and my stocks, my gold stocks, my oil stocks, my oil exchange traded funds, I think that that's going to happen. And then I can basically make some trades on the indexes stocks that are in the portfolio, or the indexes that are highly correlated to the overall values of the assets in my portfolio. So if I think that the values are going to go down, I want to hedge off the portfolio, and I can do that by applying the insurance and the financial engineering and the derivatives as the tools. I can write the forwards. I can write the futures. I can write the calls on the futures. And I can buy puts on the futures. And if I think the values of my exchange traded funds are going to go down, I can sell them short. I can write calls, and I can buy puts. And I can do the exact same thing for the stocks in my portfolio. And if I apply this, it bows out the efficient frontier. Yes, my returns come down a little bit, but I can significantly reduce the portfolio risk, and I can increase my risk-adjusted rate of return. And if I can get an 8 to 10% rate of return on my portfolio at the lower expected return, my portfolio is going to double in less than 10 years. So I'm better off. Okay. And then the other question was on the derivatives. What do I think is going to happen? Or, how would I apply the derivative contracts if I thought prices were going to go up? Well, if I think prices are going to go up, index, I'm going to buy forwards, I'm going to buy futures, I'm going to buy the calls on futures, and I'm going to write puts on the futures. For the ETFs, I'm going to buy on margin. I'm going to buy the calls. And I'm going to write the puts. And for the stocks, it's going to be the exact same thing. Okay. You guys want to take a picture of that? I'll probably be maybe 10, 20 more minutes. I'll let you go, unless you gotta go already. Okay. Can I erase this? We're almost done. A few more minutes. So that's the tough one, right? That's really the hardest one. And if you can nail this one, you got it, right? So it's really into the details. And I'll upload this as soon as possible. So you have it. This is very Buddhist, right? You spend all this time building this, building it out, and then you just erase it. Because then you do it over again and make it better every time. It's like those sand mandalas. Have you ever seen those before? The sand mandalas? Have you seen those? At the Asian Art Museum in San Francisco, they'll bring in the monks. They'll spend like 3-4 days doing these beautiful mandalas. They're amazing. And you're just like, wow, this is amazing. And then at the end of the thing, okay, Joey, get in there. Shh, shh, shh. And that's it. Okay. Right? Because it's not, it's not the permanency of the art itself, it's the intellectual spirituality that is really infinite, right? Okay, so let's do I want to do the intrinsic valuation next, because it's easier. Okay. And these are pretty simple. Because you applied this already, but I want you to memorize the theoretical formula. So perpetuity is pretty straightforward. It's your cash flow, T+1, so next year. This cash flow could be, earnings. You're valuing a firm. Could be EBITDA or EBIT. You're valuing a startup company or a newly established company at the firm level. And you can also do it on a per share basis. And you can also use dividends if you want to, but I'm not a big fan of dividends. Using the value stocks, we use EPS. Your earnings per share is what you're going to use for established firms, and then you use EBIT or EBITDA or some other kind of free cash flow. And I think we do funds from operations. Or FFO. This is what we use to value REIT stocks, real estate investment trust stocks. So that's your cash flow. CFO T+1, so you're always forward looking. And the cash flows are assumed to be flat forever, into perpetuity. So you can just put a little line over it to indicate that it's a constant. And then you divide it by I. It's going to give you the value based on the perpetuity model. Now this I is your expected return. It's also called the discount rate. If I'm using a coupon from bond, if I'm using a coupon, this would be an interest rate. And I could also use the capital asset pricing model if I'm using dividends or earnings per share. And I could use the weighted average cost of capital if I'm trying to do firm level valuations. So it depends on what your application is. Okay. And then the Gordon growth, which is constant. It's the constant growth model. It's the same model, but the cash flows are not constant forever, and they actually grow at a constant rate. So the G is going to give you the valuation using the Gordon growth model. And then the multiple approach basically states that you're taking the same cash flow next year and you're multiplying it by a multiple projected out for next year, and then you're going to get a valuation using the multiple approach.
Where's N?
That's the multiple. I'll show you what a multiple looks like in a second. Okay. So I can calculate a multiple. Let's say I know the firm level cash flow, either earnings or EBITDA or whatever it is. I can go out into the marketplace and I can find firms that have sold at some valuation. And if I know the cash flow, say in this case, EBITDA, I can take whatever it's sold for divided by the annual cash flow and I can get a multiple at the firm level. I can even take earnings if I want to and divide it by the value to get a multiple. At the firm level, the value of the firm. So I can do that. I can also use price. I can use stock price to earnings per share. So if I know what I think I know what the stock price is going to be, and I know what earnings per share is going to be, I can come up with a PE multiple. And apply it to the future cash flow to get the value of the company, or actually the value of the share. So this is firm level, this is stock level. I can also manufacture multiples. 1 divided by I is going to give me a multiple using the perpetuity model. Take that, multiply by the cash flow, get the value, it's the same one as perpetuity. I'm just looking at it differently. I can also take 1 divided by I minus G, and I can get a multiple using the Gordon growth model. That multiply by the future cash flow. To get the value, it's going to be the exact same as the Gordon growth model. Okay, everybody follow so far? We'll do more of this later on. This is just theoretical. I just like to grind you and a solid foundation in the evaluation theory, and then we start to apply it. Usually, most professors will teach the application first, so you're always asking questions why. I try to grind it in theory and then do the application, either simultaneously or slightly after. Okay, any questions on this? Okay, and then the last one is discounted cash flow for the DCI. And in this case, you're going to be calculating the present value. So let's say I have a 2-period model. It could be 2 or 3, I'm just going to use 2. I usually like to set it up. So I know it's a 2-period model, so it's 1 plus I to the 1 and 1 plus I to the 2. Does it say in there what, does it say anything on the DCF if you got to do a 2 or 3 period? No, it just asks for a. Okay, so you got that. Then what you're going to do is you're going to take cash flow, T equals 0, so last year's cash flow, right? And you're going to multiply it by 1 plus G to get CFO T plus 1. So you do last year's cash flow, multiply it by 1 plus G, and you're going to get CFO T plus 1. Then you're going to grow this one out, 1 plus G to get CFO T plus 2. And then what you're going to do is you're going to grow this out one more time, right? 1 plus G to get CFO T plus 3. And what we're trying to get here is the terminal value. We're going to divide the terminal value. If we assume that the cash flows are going to remain flat forever, then we're going to use the perpetuity model to get the terminal value using the perpetuity. Or I can take the cash flow and I can divide it by I minus G and get the terminal value using the Gordon growth model. Then what I'll do is I'll take this terminal value, last year's cash flow. And then I'm going to discount it back at the discount factor to get the discounted cash flow. I'm going to do the same thing for this one. And then I add them all up to the present value using the discounted cash flow method. Okay, we're almost done. I'm not going to do the product innovation. That's like another half hour. do the technical analysis really quickly, 'cause that's pretty easy. Okay, any questions on these? With all your practice on your homeworks, and so do you want to take a picture of this? With all the practice with your homeworks and the extra credit problem set, this should be starting to get natural for you. Any questions? Comments? Ready to take a nap? I'm ready. Nice Sunday afternoon now. Okay, last call. Okay. Now I'll leave the list of the technical analysis up to you. I mean, it's really momentum trading, Dow theory, Wyckoff method, linear regression, time series analysis, volume charting, head and shoulders, flags and wedge patterns, head and shoulders patterns. Those are all just the technical trading techniques. And you can even Google and add some stuff to it if you want to. But we use the best traders, the best analysts that I know, they use both technical and fundamental analysis combined to do a better job of trading and making recommendations, evaluations, and that stuff. So what I'm looking for here, there's kind of, I guess, a science to setting up the technical trading charts. There's two down here, one up here. I always forget which one's up here. I think this might be the MAH01340. And this one's the RSI. And this is the volume chart right there. And then usually, let's say this is 3 years of Yahoo price data. So I'm more familiar with that. So usually the stock price will start, and then it starts to trade in a range, and then it breaks out to the upside, peaks this, and then we come down, trade a little bit here, break out to the upside, trade a little bit here, and like that. This is what what Yahoo did. So this is the price chart. So the first thing I want to identify is right here. This is my support line. So the stock price just keeps bouncing off this support. So it's forming a support. Then, as you can see, it's bouncing off the top. So it's creating a resistance. And then all of a sudden something happens, some news hits, right? And the stock breaks out. Break to the upside. Something happened that changed the expectations. And then as you can see, the stock price went up. Oh, it looked like it formed another support here. It looks like it formed another resistance here. It looked like the stock peaked here. And then it looks like it broke through again. The downside. It looks like it, actually this should be down like this. This is what we see a lot of times. The stock price will form another support at the prior resistance. Now, as you can see, this one, using Dow theory, this is a shoulder, this is a head, it's another shoulder. So this is called a head and shoulder pattern. Okay, then you got another breakout, looks like you have a little support, you got a little resistance right there. Then something happened, and it broke out again to the downside. Down like this again. It usually forms a support based on the prior support. And then if you were Yahoo, you went down like that. And as you can see, this period, the stock was in a upward trend line. And at this point, it's in a downward trend. And then what you'll see is in these periods right here, the RSIs will be moving up. Up, when the stock price goes up, they move down. When the stock price moves up, they move up. When the stock price goes up, and then they move down. The stock price goes down. And then they have like another, something like this. So these moving averages, the momentum indicators, will give you an indicator of where the stock price is going to go in the future. And then the same thing with the RSI, it's the same thing. It moves up when the stock prices go up and moves down when the stock price is trending down. And we have like another intermediate one too. And then we also look at volume charts. So when the stock price is going up, the volume goes up, and when we're in a trading range, the volume gets really thin, and then it picks up again when the stock price gets pushed up. Peak, and then as you can see, really high sell-off volume as people start to dump the stock. And then this period, this position right here, when the stock is trading sideways, it's also called a sideways pattern. It's also called an accumulation phase. It's also called a consolidation. During these periods, usually low trading volume, and the stock price doesn't know where it's going because there's no information coming in. So it starts to trade sideways and starts to trade thin. And then something will hit, either it'll break out to the upside or downside, depending on the information. Okay, so that's what I'm looking for. So it's not too hard. And then I'll let you do the product innovation stuff. And I don't think we need to go through any of the problems. I think they're pretty straightforward. It's just that 8.1, the bond price. You know, the first thing I look at, you know, in these well, they're asking you to calculate the bond price. So the first thing I look at in these things is the coupon interest rate in 8.1 is 8%, and the market rate is 6. So just to check your answer, you would know that the bond price is going to trade at a premium, right? Because the coupon's higher than the market. Okay, so it's going to trade at a premium. And then the other one, the other bond calculation, the yield to maturity, which is 8.10, is the same thing. So you know that it's asking you for what the market interest rate is and what the yield to maturity on the bond is. We know that the bond is trading at a discount at $868.43. So the market rate's got to be higher than 6%. So they asked you to solve the problem through interpolation, which would be extremely excruciating if you were to run the whole thing at 7, 8, 9, 10. But they did say, hey, try 10% and see what you come up with. So if you can just show me a 10, because it's only 4 periods, so it's really 8 periods on a semi-annual basis. Is it semi-annual? Yeah. So you just show me 8 discounted cash flows. Just remember that in the last 8 years, you get your $1,000 back. Okay. So then you put in the semi-annual coupon, you put in your semi-annual interest rate, and you discount it back at 10, you know, at 0.05, right? Because it's 10% divided by 0.05. I mean, by 2, that's 0.05. So just show me one discount account. I don't care which one. If you don't use 10 or not, I don't care. It's just, do you know how to calculate a present value for a bond? And really the tricky thing is you got to put the $1,000 in to the 8th period, right? Because you get the premium back. Okay. And then I think all the other ones are pretty easy, just tedious, right? And I think that's it. I'm sorry I ran over. I'm sorry I was late. I'll never do it again. So if you, and I'll do this again tomorrow too. If you guys wanna come and run through it again, I'll do it again tomorrow.